Namaste and welcome to part D of cash flow under Simple Solutions series. This is an illustration number 19 from page 302 of CME study notes. As the first step, we have an initial review of the problem and we ascertain what is column 1 and what is column 2. Column 1 31st March 2015 previous year and column 2 31st March 2016 current year. Here amount of given as in 1000 rupees. If you look into adjustments, there are figures like 48,000 and you have to put certain figures like 5% of values. Going for thousands will inconvenience you. It is better to convert the entire workings into absolute rupees. Means it is 38 lakh 40,000, 45 lakh 60,000. That will be a better way of doing it for convenience. And this problem simply states prepare a cash flow statement. Particularly in respect of operating activities, we can have direct or indirect. Here we have a standard template of indirect way of calculating operating activities flow. We will continue with indirect. Working note required. See, wherever there are adjustments involved, instead of doing it directly, it is better to route it through a working note. If you see here now, you have got details of fixed assets, accumulated depreciation, annual depreciation, investment sales, valuation of closing stock, 10% undervaluation, realistic valuation, fixed assets, debentures redemption. Therefore, what we could do is fixed assets, we need to have a working note. Investment, we need to have a working note. Stock and other assets, since there is a breakup between the two, we can have it. And 9% debentures. You have to remember one thing now. The moment percentage is indicated, it is a debenture, a debt whose interest has to be charged during the year, whether it is provided or not. Here we have to calculate interest, and there is a premium which says debentures are redeemed at 105. We will come to this point separately later, but we need to calculate debenture premium as well as interest. Now let's get going. First we take the profit and loss account, difference between the two balances at the year ends, 72,000 indicated. Go to the next. Let us start from the top. Share capital 19 lakh 20,000 from 14 lakh 40,000. Difference is 4 lakh 80,000. This belongs to financial activities. Therefore, it will come here. We have got capital reserve and general reserve. If you see some comments in the additional information, they have treated these capital reserves separately. Let us not complicate it. Both let us route it through profit and loss account. Therefore, any increase in capital reserve, any increase in general reserve, let us presume that it has been routed through profit and loss account. Since it was transferred from there, let us add it back. 48,000 and 9,60,000 minus 8,16,000, 1,44,000, both will be added. Third thing, we have taken profit and loss account already, 9% debentures. Watch this very carefully. 9,60,000 is the opening balance. This is as per the balance sheet summary given. Then you find at the end of the year, there is a closing balance of 6,72,000. Means if 9,60,000 and 6,72,000 is the two balances, difference is debentures redeemed. Let us take it to debenture redeemed account for the sake of clarity. The differential figure, we bring it here, 2,88,000. Now come back to adjustments. Debentures are redeemed at 105. This is the crude way of giving explanation. Right thing would have been 5% is the premium on redemption, or 100 rupees worth of debenture is redeemed at 105. Means 5 rupees on 100. Means on 2,88,000, 5% will come to 14,400. That is the amount of redemption premium which we have to pay based on this. And 2,88,000 with redemption premium, the amount required to be paid as a cash outflow is 3,02,400 and the debentures are at 9%. The question is, our opening balance was 9,60,000 and our closing balance is 6,72,000. In that case, on which amount you will be paying the interest? It is easy to presume that whatever redemption we did in the beginning of the year. Therefore, throughout the year we used 6,72,000. On 6,72,000 at 9%, we provide for interest, and in profit and loss account we presume interest is provided for, and in cash flow the interest is paid out. Therefore, it is a contra item. We will take this also. Effectively, we have redemption premium, we have payment of debentures, total amount, third, provision of interest and payment of interest. Come to cash flow. We have redemption premium, debenture cash payment and interest. Like both of them belong to debentures. If we take from the working summary, 14,400 redemption premium, 3,02,400 cash paid, which is shown under financing activities. Interest is charged to profit and loss account, now reversed and added back, and interest is paid out as a cash flow. This deals with these four aspects. We should be very careful about the debentures. Let us take now next item, current liabilities. Current liabilities from 5,76,000 to 6,24,000. 48,000 is the increase. Any increase in current liabilities is a source, therefore it is positive. It comes under non-operating items, but above working capital changes as a composition. It is not an expense, but it is a cash flow. Then comes proposed dividend. Proposed dividend is a provision which was deducted out of profits. Provision we have to add back, cash flow we have to deduct. 1,74,000 was the provision made, proposed dividend. Now we reverse and add it back to profits. Then we have actual payment. Previous year's dividend was 1,44,000. Out of that, still unpaid is 18,000. Means 1,44,000 minus 18 is 1,26,000 is the amount of dividend actually paid, and it is pertaining to equity, hence it is coming under financing activities. We show it under financing activities. Then our next item is provision for tax. Same logic we are using. Current year provision is added back to profits. Previous year's provision is paid out. 4,08,000 provision for tax, it reduced our profit. It is a non-cash item, therefore added back. 4,32,000 is a cash item, but it pertains to investing activities. Financing tax is for the operations. It is a part of operating activities. It is shown as payments. Income tax paid or tax of the previous year paid during the current year. That takes us to the biggest of the lot with 4 adjustment entries involved, but it is easy to understand. Let's go ahead. Let us take fixed assets. Opening balance. It is 38,40,000. Second point, you come here. During the year 2015-16, fixed assets with a book value of 2,40,000 was sold. Therefore, cost of equipment sold we take as 2,40,000. Then come here down. It was decided to write off fixed assets costing 60,000. That will also reduce the gross block. Once you reduce 60,000, 2,40,000, what was the balance left out? Balance left out was 45,60,000. We take the total 48,60,000. Our opening balance was 38,40,000. Therefore, we acquired, there was a cash flow for purchase of assets to the extent of 10,20,000. This is making use of these 3 adjustment entries. Now 45,60,000 is our closing balance. What do we do with it now? We say we have accumulated depreciation account. Opening balance is 11,04,000, closing balance as 13,92,000. And it says whatever we sold on that asset, there was a depreciation of 84,000, and it was decided to write off 60,000, of which accumulated depreciation was 48,000. And here we have got a closing balance of 1392. 15,24,000 is the total. Out of that, opening balance was 11,04,000. Means it is already indicated here that during the year we provided for a depreciation of 4,20,000, and that brings us to balancing the two accounts. Means we have three items: depreciation on sales, depreciation on write-off, and depreciation during the year. But this depreciation during the year goes as an entry. These two we will handle separately under the sub accounts. Now we have got fixed assets sold account. We said cost of equipment sold is 2,40,000. Fine. Then we saw it had accumulated a depreciation of 84,000. And we sold it for 1,20,000. It is a cash flow. The amount comes inside. Therefore, it is item number 3, which goes to cash flow. And an item called worth 2,40,000, on which depreciation was 84. We received 120, means we made a loss, which was booked to profit and loss account. This also we need to consider there. 36,000. Then we will be left with the fifth one. Cost of equipment written off is 60,000. Depreciation on it was 48,000. Therefore, net effect during the year, which reduced our profit, was 12,000. Hence, in fixed assets, there will be 5 entries to be noted, and this we have to carefully do so that we have got a grasp on everything and everything is perfectly balanced. We go back to cash flow. Give effect to these entries. We have, in respect of fixed assets, 2 sets of entries. One, reversal. Depreciation was charged, we reverse because it is non-cash. Loss written off on fixed assets, it is non-cash. Loss on sale of fixed assets is a non-cash. All the 3, we add it back because they reduced our profits. Second, purchase of fixed assets is a cash flow. Cash flow of fixed assets is under investing activities. Any cash flow received under fixed assets is a investing activity. These are the 5 items. We have the items ready with us. Item number 1, purchased assets. Cash flow goes out 10,20,000. Then number 2, we charged depreciation of 4,20,000. We add it back. Number 3, we have 1,20,000 which we received, means it is a positive cash flow. Cash comes in. Number 4, loss on sale of assets, which was deducted. Now we add it back to profits. Number 5, loss on write-off is 12,000, which we add it back. These 5 are the total impact of fixed assets. That takes us to the next account of investment. Opening balance of investment was 4,80,000 and its closing balance is 3,84,000. And there is no mention of any purchase of investments during the year. The fall is mainly due to 96,000 investments sold. Therefore, investments at cost sold is 96,000, which we just transfer it to investment sold account for clarity, though it is not required, but go to it. Some investments sold at a profit of 48,000. This was the investment sold at profit 48 number, means if it is 96,000, we sold it at 1,44,000. We made a profit of 48,000. This is what this entry talks about. 48,000 is the profit on sale of investments. When we sold it, we received money to the extent of 1,44,000. These are the 2 entries. It goes into cash flow. This amount profit on sale of investments was added to profit and loss account. Now we will deduct it because it is a non-operational item. It is not an operational item. Second, we take into account the cash flow which comes under investing activities. 1,44,000. Come back here. 1,44,000 sale of investments we receive, and loss on sale of fixed assets. Sorry, profit on sale of investments which we had added earlier. Now we deduct it. That way, these are the two entries, 48,000 and 1,44,000 takes care of. Let us start with the stock and other current assets. It is 11,34,000. Out of that, stock is 2,59,200. Therefore, the balance is other current assets 8,74,800. It is stated opening stock is undervalued to the extent of 10%. Means there is an increase in the opening stock to the extent of 28,000. Whether it is it is also to be treated similar to any other increase in the stock. Change in stock 28,800 will be an additional outflow which is not accounted so far. Then we have closing balance of 3,60,000 as indicated. If 2,59,000 plus 28,800, the differential is change in the stock during the period, which is a cash flow item which involves usage of cash, means it is negative. With this, we go to the other component of other current account. Closing balance is 12,72,000 both put together. If inventory is 3,60,000, 9,12,000 is other current account. Difference between the two is change in other current accounts. Therefore, in all the three accounts, there is an increase in the outflow because the asset is increasing from 11,34,000 to 12,72,000 because of these three additional outflows. In the cash flow, all three will appear together as change in stock because of impact of opening stock, change in stock, real increase during the period, and change in other current assets. That done, we are into preliminary expenses. Preliminary expenses written off during the year. 96,000 became 48 means during the year we wrote off 48,000. When you write off, you deduct from profit. Since it is a non-operational item, non-cash item, we add it back to profits. 48,000 is added back. Coming back, we have now cash balance 2,10,000. Once we achieve this, this is the stage where we have covered all assets, all adjustments. We strike the totals at different stages. $3,12,000 is the resulting amount. 3,12,000 is the resulting cash balance. Both are matched. That way we have covered all balance sheet items and also additional information and given a cash flow during the year. And from 72,000, from 1,02,000 change in the cash and cash equivalents during the year, the cash balance moved from 2,10,000 to 3,12,000. Congratulations. Thank you so much. Thanks a lot.